Cash flow statement. What is that? Hey taxpayers, I'm back with another installment of What is That, where we discuss financial term and topics you may have heard, but we make them super easy to understand. Today, we're talking about the cash flow statement because we know more than ever for business owners, you have to know where did the cash go. I love talking about cash. It's one of my favorite subjects. So this is one of the statements that you should be receiving every single month from your accountant. And if you're not, you want to start requesting it. In 1987, this was the first time publicly traded companies were required to now add the cash flow statement as part of a full set of financial statements to give to the public. The statement of cash flows, also known as the cash flow statement, basically summarizes the ins and outs of cash in your business. And there's a common misconception that your profit and loss does this, but that's not true. You see, your profit and loss only captures the income and the expenses you had, but it doesn't capture all of the outflows or all of the inflows. And that's what the cash flow statement is. You see, on your balance sheet, there are inflows and outflows that never make their way to the P&L. For example, you might take on some debt. You might buy some fixed asset, basically furniture or equipment or a building. You might decide to do a profit distribution as a business owner. Those three things, they'll never make it to a P&L. And that's why you need your cash flow statement, because it takes both your P&L and your balance sheet and summarizes the cash movements of both these statements all in one. It's the cash flow movement of your entire business. Now there's three main sections to the cash flow statement. There's the operating activities, the investing activities, and the financing activity. The operating section is going to be how much cash you generated and spent related to the product or service you sold. The investing activities are going to be related to whatever you purchased in your business to expand it. So think fixed assets, right? Maybe you bought equipment, maybe you purchased a new building. And the third section is the financing activities. This is where maybe as a business owner, you invested money into the business, or you took on a loan, or you paid down debt. Simply put, the cash flow statement takes all these aspects of your business and adds and subtracts to arrive at what was your net cash movement, right? If you started with $100,000 at the beginning of the month and ended with $150,000, what aspects, which activities generated and added cash and which subtracted cash from your business? So follow me now as we put a fictitious cash flow statement up on the screen and we talk about exactly what we're looking at here. So when I'm explaining a cash flow statement to someone for the first time, I like to focus on the totals because it's easier to conceptualize from a big picture what we're looking at before we dive into some of the details. So what I want you to look at here is the line item that says cash provided or used in operating activities, cash provided or used in investing activities, cash provided or used in financing activities. Let's focus just on those totals alone. So if we look at those totals, basically this business earned $25,000 net in cash from its product or service. It then spent $21,000 in investing activities, right? Because it's negative. So it spent about $21,000 in investing activities. And lastly, it then spent $3,000 in financing activities. So it used $25,000 from operating to spend money in investing and financing activities and ultimately ended up with only a $1,000 increase in their net cash flow. This is why the cash flow statement is so important. If you look at your P&L for the month, your net income is going to show as $25,000 on cash basis. And the first thing you're going to say as a business owner is, where is that $25,000? Because it's not in my bank account. You don't know how many times I've answered that question. And it comes right here from the cash flow statement. The reason why you as a business owner do not have that $25,000 in your bank account is because you purchased $28,000 worth of capital expenditures, right? You bought fixed assets. Now you sold property, which you received $7,000, and that certainly helped, but ultimately $21,000 was invested in some sort of piece of equipment. And since I have access to your balance sheet, I'll take a look there and tell you specifically what equipment you purchased that created that negative cash flow. Next is the financing activities. If we jump into the nitty gritty here, you borrowed $10,000 worth of debt. This was new cash that came in, but you also took cash dividends and purchased treasury stock. So ultimately, there's a net out cash flow here of $3,000, which is reducing your cash. Now, to me, this isn't a bad cash flow statement, right? The business made money and it chose to invest it, and hopefully this capital expenditure, which was the biggest impact to this cash flow statement, will create more than $25,000 in income in a future period. So truthfully speaking, even though this business worked so hard to generate $25,000 and only added $1,000 of cash to its bank account, it's possible that this business could earn a lot more since it's invested in investing activities that could produce more income in operating activities. So what do you think about the cash flow statement? Do you find it easy to read? Have you ever seen one of these before? Has your account ever explained it to you? We hope you enjoyed this latest installment of What Is That? Hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.